Welcome to CNN Vantage Point. I'm Jay Over, investment strategist with CNN Wealth Management, and today's podcast will provide a market review for the month of June 2024 and our current outlook. U.S. large company stocks experienced a strong first half of 2024. However, performance continues to be largely driven by a handful of giant growth companies that propelled the S&P 500 index to reach 31 all-time closing highs this year. Excitement around artificial intelligence continues, and chipmaker NVIDIA stock has returned nearly 150% this year. In June, the S&P 500 index briefly crossed above the 5,500 threshold and returned 3.6%, outperforming the less concentrated equal-weighted S&P 500 index by 4%. Foreign equity exposure was mixed during the month, with the MSCI Emerging Market Index returning 4%, while the developed MSCI EAFE Index posted a decline of 1.6%. Uncertainty surrounding elections in France weighed on foreign developed equities. U.S. small company stocks remain pressured by elevated financing costs and weaker profit margins. The financials-heavy Russell 2000 Value Index lost 1.7% in June and has declined nearly 1% in 2024. Fixed income yields modestly declined in June. The 2- and 10-year Treasury yields fell 18 and 15 basis points respectively. The Federal Reserve made no changes to the Fed funds rate at their June meeting. The Fed's updated summary of economic projections shows just 0.25% rate cut this year. However, Fed funds futures are pricing 2.25% rate cuts by year-end. The prospect of lower rates and a positive economic backdrop have benefited lower quality, higher yielding bonds. The Bloomberg U.S. Corporate High Yield Index has returned 2.6% this year, while the Bloomberg U.S. Treasury Index has declined nearly 1%. Employment remains strong, but we see evidence that its strength is receding. Job openings have declined to their lowest level in 3 years. The cooling labor market may be a positive for equity markets, as we expect this will translate into lower wage growth, which, in turn, will feed into lower inflation numbers. The labor market is a key factor in Fed decisions. We believe a softer labor market will help the Federal Reserve pivot to a position of initiating rate cuts sometime this fall. Meanwhile, corporate earnings continue to be solid. Fed rate cuts will reduce the yields of money markets and other short-term fixed income investments. Money market balances stand around $6 trillion, near an all-time record high. We expect this liquid asset class will provide support to equities, and equity market pullbacks will be short-lived as investors buy into equity weakness. With this constructive equity backdrop as our base case outlook, we implemented portfolio changes in June that modestly increased our overall equity exposure. Within our moderate model portfolio, we increased our equity allocation to domestic large cap growth, mid cap, and foreign large value. These increases were funded by reductions from ultra short bond and commodities. We'd like to remind our listeners that market conditions can change quickly. As circumstances and facts change, CNN's market views and portfolio positioning may change accordingly. If you would like more information about our current positioning and market thoughts, please contact any of our wealth management advisors. And if you like this podcast, we'd be grateful if you would share it with your friends. On behalf of the entire CNN Wealth Management team, we thank you for listening.
Please note, views are subject to change based on market conditions and other factors. These views should not be construed as recommendation for any specific security or sector. Client portfolios may or may not be at the positionings discussed due to, but not limited to, distributions, tax management limitations, systematic purchases, etc. Some products are not FDIC insured or guaranteed, not a deposit or other obligation of the bank, not guaranteed by the bank, and are subject to investment risk, including the possible loss of principal amount invested, and are not insured by any other federal government agency.